Hey guys, Dave Keller here with Market Misbehavior. Normally on a weekday after the close, I'm recording the final bar. We didn't have a live show today, so I wanted to share with you that last segment of my show every day is called the 3 and 3. It's where I hit on 3 key charts in 3 minutes. I might take a little bit longer today because I have a little more time on this kind of video, but I did want to share with you the 3 key charts that I think tell the story of this market. In about 5 minutes, we'll aim for them. A lot of distribution, obviously. Monday's session fairly choppy and sideways. Today, a higher open, closing at the lows of the day. The S&P down 2%, the Nasdaq down 3%. Mid caps and small caps down as well, but outperforming the S&P by a little bit. It was all energy at the top of the list, with energy up, everything else down. So here are the 3 charts that I would use to tell the story of this market environment. And it starts with what I used to call the FANMAG stocks, because it was Facebook, Amazon, Netflix, Microsoft, Apple, and Google. Now that a number of them have changed names, Facebook is now Meta, Google is now Alphabet. I guess we have to go with the phenomena stocks. I'll keep working on a better acronym. If you have a better suggestion for how to group these 6 names together in a meaningful way, let me know in the comments below. But this is the FANG Plus Index. This is my chart number 1. Basically, the New York Stock Exchange FANG Plus Index has made a higher low in June versus May. So, one of the key metrics or the key measures of the weakness in this market has been the market making new lows every month. And if you look at the chart of the S&P 500, pretty much every month we have made a new low. We just barely did it there in April and March. We didn't quite undercut February on an intraday basis, but we did on a closing basis. So overall, it's been a pretty decent measure. The FANG Plus Index actually did not make a new low so far in June, which is interesting. However, the 6 or 5 of these 6 stocks that I'm about to show you actually did make a new low so far in June. So here's Meta, fresh off of a new 52-week low last week. Here's Apple with its new low in mid-June. Netflix really not quite making a new low, but testing it. This is probably as close to a double bottom as you'll find. Some of these are either clearly new lows or higher lows. Netflix is maybe the one that's relatively stable. Microsoft has undercut its May low. Amazon actually similar to Netflix. It's sort of holding stable, not quite breaking below previous support, but sort of testing it. And Alphabet is the only one of these 6 that is not either at or near a new low in June. Now, again, pretty close. I mean, I'm splitting hairs here, but if I look at the pure trend, Alphabet's the only one with a clear higher low in June. The rest of these are either even, as you see with Amazon, or making a clearly lower low in Microsoft. The point and why this is chart number 1 is because I would argue for this downtrend, this bear market phase to be over, for us to start, seeing signs of strength and talking about a renewed bullish phase, or the possibility of that happening. You would need to see these stocks rotate higher. And the reason is this: our benchmarks are tied very much to these 6 stocks. These 6 stocks are the mega cap tech consumer communications names. It is inconceivable that the major indexes, the S&P and the Nasdaq, could mount any meaningful rally without these 6 stocks being a participant in that. Now, it's not to say that individual names can't do well, and we'll look at an energy stock here in a short while. However, for the broad indexes to do well, these stocks need to do better, which means things like Alphabet would have to hold those recent lows at 2,100. Something like Amazon would have to hold above 100. Netflix would have to hold above its this sort of double bottom range, and Microsoft and Meta would have to stop making new lows. So all of those, that's a lot of ifs that we would need to see to turn less negative. I'm not seeing it yet. Chart number 2 is the relative strength of consumer discretionary versus consumer staples. This is a ratio I just call offense versus defense. It's looking at the consumer space and seeing, are people investing more in things you want or things you need? In bull market phases, we are able to allocate capital to things we want, like luxury purchases, discretionary purchases. When things are getting rough, we just limit our spending or rotate our spending more to the things that we need, that we're going to spend on in any environment. Things like household goods, alcohol, tobacco all sort of fit into that bucket as well. This ratio has been clearly going lower from November of last year, which is when I would argue the bull market phase really ended, and where we're at now in late June. Now, neither one of these has made a new low in June, similar to the FANG Plus Index. However, neither of them are really emerging in any sort of strength. You've seen random bounces along the way, but it always resolves to the downside. So this ratio would have to attempt to make a new low and fail. At this point, certainly seems heavy on both cases. And I think the most important one to watch is the equal weighted version, which gives you more of a broad perspective of consumer discretionary versus consumer staples. The third chart for me is Diamondback Energy, ticker FANG, and this is not the FANG index of any sort. It's a stock with the ticker FANG. Diamondback shows you the pullback that we've seen recently. It's a great example to tell the story of energy over the last couple of months. Big run higher through the first quarter of 2022, more of a sideways move, March, April, May, made a new all-time high going into the beginning of June, and then from there rupturing pretty quickly. Most of these stocks have failed to hold their 50-day moving average. Many of them are testing their 200-day moving average, and certainly many of them are testing previous support. Diamondback sort of combines all of those into one chart. It made a new high in June, then undercut the 50-day moving average, and now is testing the same support level, just around 115 to 120, which is where we were in late April, also where we were in mid-March. That also lines up beautifully with the 200-day moving average, which is right where the stock found support in August. And it's essentially been above the 200-day from all the way back here in November of 2020. So this is a stock that's been in a pretty good uptrend. The relative strength has been exceptionally strong as it's outperformed pretty much everything, making new highs while the major indexes are making new lows every month. But now it's pulled back. And the reason why this chart is so important is this. There could be a scenario where the major indexes are flat to down because of the weakness in the growth areas in the market, but something like energy recovers and actually has a pretty decent summer. Energy prices are going higher. Crude oil prices certainly not rupturing too much. And as a result, energy stocks could hold up, which would mean a stock like FANG would need to find support here. I would need to illustrate the fact that buyers are coming in and buying on the short-term weakness of this price and ready to push FANG back up to previous highs around $160, $165 a share. So that's why it's an important chart there. It's also an important chart because the bear market scenario, in my opinion, would mean energy stocks would have to keep going lower for us to see a full rotation to risk off. Not only would the phenomena or the FANG plus stocks, FANMAG stocks that I talked about 2 charts ago, not only would those have to continue lower, but you'd also, I think, have to see energy fail to hold support. A lot of these stocks have pulled back to viable levels. You know, if you think about the short-term weakness, but the long-term uptrends, if they fail to hold that, the FANG stocks fail to hold, that indicates a broader rotation still into risk off mode. That tells you people don't want to own anything. Investors don't even want to own energy, which has been by far the best sector in 2022. That, I think, would be the fuel that could cause the major averages to their next big leg down. That could propel the S&P down to 3,200 or something like that, even lower, if investors move full risk off. So those are the 3 charts that I think are most important to watch here. Number 1, the phenomena stocks. And again, if you have a better idea of what to call this group of names, Meta, Apple, Netflix, Microsoft, Amazon, Alphabet, let me know in the comments below. But you're seeing 3 buckets. They made a new low, a stable low, or a higher low. You want to see those return into more constructive patterns. And what would negate that downtrend would be breaking above the swing highs all across the board. Chart number 2 is offense versus defense, clearly still favoring defense, which tells me any rallies here are still more dead cat bounces, more short-term rallies within bear market phases. And finally, I think Diamondback Energy, ticker FANG, is a great stock to watch to see if it's able to hold support where you might expect so in a normal market environment. Is it able to hold support around 115, 120? That is my quick take on 3 charts in just over 3 minutes. Thanks for joining me, and I'll be back with you again tomorrow. Bye now.